Welcome to the Deep Dive, where we break down the key insights from the financial world. Today, we're jumping into the INDB second quarter 2025 earnings conference call.
Yeah, and it was quite an eventful quarter for them. Lots of moving parts, some big strategic decisions being made.
Absolutely. Seems like they're really trying to set a clear direction. So our goal today is simple. Cut through the jargon, give you the essential takeaways on INDB. Let's kick things off with the headline numbers. What did the quarter look like financially?
Okay, so GAAP net income reported was $51.1 million. That works out to $1.20 per share, diluted.
Right.
But if you look at the adjusted operating net income, that was a bit higher, $53.5 million, or 1.25 diluted EPS.
Okay, so a slight bump on the adjusted side. What about core profitability?
Yeah, that's where the operating pre-provision net revenue, or PPNR, comes in. Their return on average assets for PPNR was 1.53%. And for you listening, PPNR basically shows how the bank's doing before setting aside money for potential loan losses. So 1.53% is pretty healthy, indicates a solid core business there.
That PPNR figure does paint a good picture. And tangible book value, I heard that showed some decent growth too.
It really did, up 2.1% just in the first quarter. And get this, 8% higher than the same time last year.
Wow, 8% year over year.
Yeah, that's an increase of $1.99 per share just in Q2 alone. So solid growth there.
Okay, so good underlying numbers. What were the main things pushing these results? What were the tailwinds?
Well, a few key things. Their net interest margin, the NI, performed better than expected. That was a big one. They also saw strong growth in commercial and industrial loans, CNI, gathered deposits effectively, and had lower credit costs.
Sounds like a good mix.
It is. But it wasn't all smooth sailing. These positives were dampened a bit by higher expenses, and importantly, the continued planned runoff in their commercial real estate portfolio, CRE.
Right, that CRE piece, it feels like that's been a major theme for them. Let's really dive into that. How are they managing this CRE concentration? It seems like a cornerstone of their strategy.
It absolutely is. Managing CRE concentration is, front and center. They did manage to reduce it to 274% in the quarter, which is progress.
Okay, 274%.
But, and this is important, the enterprise acquisition that just closed, that's going to temporarily push it back up. Think somewhere between 310% and 315%.
Ah, okay. So a step back before moving forward again.
Exactly. Their stated goal, though, is pretty ambitious.
Yeah.
Get that concentration down to 290% by the end of 2027. And they're not just waiting for loans to pay off. They're talking about normal amortization, yes, but also active loan sales where it makes sense. It's a very active de-risking strategy.
So it's a two-pronged approach then. Reduce CRE risk and actively build up other areas, specifically CNI.
Precisely. They need to fill that gap and also, boost deposits and fee income. They laid out a pretty clear three-segment strategy for CNI growth.
Okay, what's the first segment?
First is community banking. This is really their core. It focuses on CNI and some CRE customers too. Average loan sizes are just over $1 million. They cater mostly to CNI businesses with revenues between, say, $5 million and $50 million.
Yeah. The smaller end of the commercial market.
Yeah. And interestingly, this segment, especially now with the enterprise franchise included, got recognized by Greenwich, called the best bank in the Northeast for customer satisfaction.
That's a pretty strong endorsement. Definitely helps in a competitive market. What's the next CNI segment?
That would be their middle market and specialty business. This targets bigger fish, Massachusetts CNI companies, with revenues from $50 million up to $500 million. And they're not just doing general lending here. They're building out specific industry verticals, things like asset-based lending, dealer finance, franchise finance, even security alarm financing.
Specialized niches. So taking on bigger, more complex deals.
Exactly. This segment will handle larger credit holds, typically in the $10 million to $35 million range. It shows they're serious about moving upmarket in CNI, building deeper expertise.
Which should theoretically lead to stickier relationships and more fee income, helping diversify away from that CRE reliance.
That's the plan. Build expertise, build relationships, generate fees.
And the third part of the loan book strategy, the investment CRE portfolio.
Yeah, the strategy here is pretty blunt. Exit transactional CRE deals quickly and economically. They'll still serve their legacy clients, the ones they have long relationships with, but the focus is reduction. They know this is going to weigh on overall loan growth in the near term. It's an intentional drag.
Okay, makes sense. They're shrinking one area while trying to grow others. Speaking of growth, how did loan originations look this quarter outside of that intentional CRE pullback?
Originations were actually pretty good, quite broad-based across most areas. CRE was the exception, where they were, understandably more conservative.
And the competition, still tough out there, especially for CNI.
Oh, yeah. The CNI landscape is definitely challenging. And interestingly, they noted some other banks are starting to tiptoe back into CRE. Could be more competition down the road there, too.
Okay. What about pricing? What kind of yields were they getting on new loans?
For commercial loans closed in the quarter, yields were in the high sixes, call it 6.7% to 6.80%. Consumer loans were a bit lower, mid-60s. They seem confident their small business lending will stay strong thanks to experienced bankers and a pretty nimble central underwriting team.
So putting it all together, the CRE runoff, the CNI push, the competition, what's the outlook for overall loan growth?
Well, long term, they're aiming for mid-single-digit growth. But for now, they expect low single-digit growth. That's really until they get that CRE concentration down significantly.
Right. Prioritizing the strategic shift over just chasing loan volume right now.
Exactly. It's a deliberate trade-off.
Okay, let's pivot to asset quality. Always crucial for a bank. They reported a big drop in non-performing loans, I saw.
It did, yeah. A pretty significant decrease. Total NPLs fell 39% from Q1 down to $56.2 million. That's only 39 basis points of their total loans.
That's quite a drop. What helped drive that?
Two main things mentioned. They fully resolved a large $54 million relationship they'd acquired previously, and they also resolved a $7 million non-performing office loan.
Good progress. But it sounds like office CRE still presents some lingering challenges.
Definitely. It's not all clear skies yet. There was one specific office NPL they thought they'd resolved, but the deal fell through, so that one's being remarketed now. And they did acknowledge an overall uptick in criticized and classified loans, even though NPLs were down. They stressed they're managing it proactively, but, the work continues.
So the headline NPL number improved, but there are still specific situations needing close attention, like that big Boston office loan restructuring.
Right. That was a significant syndicated loan. Downtown Boston office property. They restructured it into what's called a Note A, Note B structure.
Can you quickly explain what that means?
Sure. Basically, they split the loan. Note A is the senior piece, more protected, which the bank usually keeps. Note B is the junior, riskier piece. It's a way to manage risk on a large, troubled loan. This particular loan also got a full payment deferral until July 2026. So while they didn't recognize any additional loss on it this quarter, it's going to stay on non-performing status for a while.
Got it. And they gave even more detail on some other criticized office loans in the Q&A, right? Really granular stuff.
They did. There's a $10 million loan with a loan to value or LTV around 90%. That one matured previously, and they're working on it.
Okay, high LTV there.
Then two new downgrades adding up to $45 million. One's a $27 million loan in Metro West Boston. It's actually current on payments, but occupancy is under pressure, around 70%. Updated appraisal puts the LTV near 69%.
Still current, but stressed.
Right. The other is an $18 million loan, also current. The issue there was apparently cash flow mismanagement by the owner. But a new management company is in place now, and the property is about 83% leased.
So challenges, but maybe manageable ones. What was management's tone on these?
The key message, and this is positive, was that the sponsors, the owners, are working with the bank. They're putting in more capital, not just, throwing the keys back.
Yeah.
That's a good sign.
Okay. And the overall provision for loan losses this quarter?
$7.2 million. Reflects that ongoing management effort.
All right, let's switch to the funding side. Deposits, the lifeblood, as you said. How did they do there?
Really strong, actually. Core deposit growth held up very well. Period end balances were up $218 million. That's about 1.4% growth for the quarter. And if you look year over year, non-time deposits, so checking, savings, money market, were up 3.6%. Their overall cost of deposits was just 1.54%.
1.54% is pretty low in this environment. That highlights the strength of their core deposit franchise.
Absolutely. It's a huge competitive advantage, gives them resilience and pricing power.
So how did this strong, low-cost funding base impact their net interest margin, the NM, in Q2? And what's the outlook?
Well, the core NIM came in at 3.37%. That was actually better than they had guided for previously.
Oh, interesting. Better than expected.
Yeah. And looking ahead to Q3, they're projecting the margin to expand further into the mid 3.60s range, maybe 3.65% or so.
What's driving that expected expansion?
It's primarily asset repricing. So their existing loans adjusting to higher rates. They also got a boost from paying down $100 million in higher cost FHLB debt back in April. That borrowing cost 4.75%.
Paying off expensive debt always helps the margin.
For sure. Their spot margin, just for the month of June, was already up to 3.40%.
What about deposit costs going forward? Are they expected to keep rising?
Management indicated that the big wave of CD repricing, older low-rate CDs maturing and renewing higher, is mostly done. So they expect deposit costs to be relatively stable from here. Future margin expansion, they think, will mostly come from the asset side loan yields increasing.
Okay, that makes sense. Now let's talk about the elephant in the room, the enterprise acquisition and the core conversions. This is a massive undertaking. How's the integration going?
It seems to be going smoothly so far. The enterprise deal officially closed July 1st. Importantly, they said no planned branch closures, no exiting businesses because of strategic mismatch. That suggests it really was a good fit.
And scale-wise, what did enterprise bring?
About $4.1 billion in loans and $4.4 billion in deposits. So a pretty significant addition.
What about the financial impact, the capital dilution and the synergies everyone looks for in these deals?
The day one tangible capital dilution is now expected to be around 8-9%. That's actually a bit better than they initially thought.
Better dilution? How come?
Mostly due to lower long-term interest rates recently, which positively impacted the fair value adjustments on things like Enterprise's securities portfolio. Their unrealized loss shrank quite a bit. Now, that slightly better dilution comes with a slightly lower earnings boost or accretion, down from maybe 28 basis points originally guided to around 25 basis points now. A bit of a trade-off there.
Okay. And the cost savings, the synergies.
It's still targeting 30% savings on Enterprise's old expense base. They expect to fully realize those savings by the first quarter of 2026.
So still on track for significant cost saves down the line. And this isn't the only system change, right? There's a bigger core conversion coming too.
That's right. Big changes on the tech front. The enterprise system conversion is planned for mid-October this year, but then the larger project is the bank-wide core conversion. They're moving off their current system Horizon onto a new one called IBS that's slated for May 2026.
Wow. So integrating one bank systems, then changing the core system for the entire combined bank a year later, that's a lot.
It's a huge operational lift, no doubt. But the potential payoff in long-term efficiency and capability is why they're doing it. It's a foundational upgrade.
Okay, let's briefly touch on non-interest income and expenses. Any highlights there?
Non-interest income was up modestly. Wealth management was a bright spot, good income there, plus decent deposit-related fees. Their wealth business grew assets under administration, AUA, by 4% to $7.4 billion. And they're expecting to add another $1.6 billion or so from enterprise. Lots of cross-sell potential there.
Good diversification potential. What about expenses?
Total expenses, if you exclude the M&A costs, were up about 1.8% from Q1. Usual stuff, mostly annual raises, director equity awards, also some higher check and fraud losses this quarter.
And the tax rate?
Reported around 22.3% for Q2. They guided to about 23% for Q3.
Okay, so let's wrap up with management's outlook and priorities. What did they guide for Q3 specifically?
For the third quarter, they expect low single-digit percentage organic loan growth for the combined bank. Combined deposits may be flat to slightly down. And both non-interest income and non-interest expense are also guided to increase in the low single-digit percentage range.
And given they just closed this big enterprise deal, are they looking for more acquisitions anytime soon?
They were pretty clear on this. M&A is not a priority right now.
Makes sense.
Yeah, they've got their hands full with the enterprise integration, the upcoming conversions, and crucially, proving they can execute on the organic growth and the CRE reduction plan. Focus is internal right now.
And overall, their tone sounded pretty confident despite all these challenges and changes.
It did. Management basically said, look, we have the pieces. Strong deposits, good liquidity, solid capital, good people, good markets, strong brand. We just need to execute to unlock the bank's inherent earnings power and get back to what they see as their historical premium valuation.
Okay, so from an investor or observer standpoint, what are the key things to really zero in on here? The strategic direction seems crystal clear now.
It does. It's all about this pivot. Disciplined CRE reduction, that targeted CNI growth push, and making the enterprise acquisition work scale and synergies. It's a major reshaping of the bank.
And the credit story is more nuanced than just the headline NPL number, right?
Absolutely. NPLs down is good, but the details on those criticized office loans, the restructuring, it shows the hard work isn't over. You need to look beyond the aggregate number to understand the real progress, the quality of the resolutions happening.
Right. So you've got these big growth and efficiency drivers, enterprise, the core conversion, but also this headwind from the CRE runoff impacting near-term growth.
Exactly. Those are the levers and the drags to watch. The enterprise deal and the tech upgrade should drive value long term. But that CRE reduction will keep overall loan growth in the low single digits for a while.
And they seem to have capital flexibility. That new buyback program signals confidence.
It does. Announcing a $150 million stock buyback, even while managing the CRE reduction and needing cash at the holding company level, suggests they feel pretty good about capital generation. Their pro forma CET1 ratio, a key strength measure, is expected to be strong, around 12.5%.
So for you listening, what are the absolute key signals to monitor going forward?
I'd say three main things. One, tangible progress on reducing that CRE concentration. Are they hitting the marks? Two, execution. How smoothly do the enterprise integration and those core conversions go? That's critical. Three, synergies. Are they actually realizing those cost savings they projected from the enterprise deal? That's key for profitability. Oh, and maybe keep an eye out for potential FASB guidance on the CECL accounting standard later this year. Could impact how banks report credit losses.
Okay, time for our not financial advice segment. Let's try to connect these dots with a potential trade idea. Remember, purely illustrative, maybe a bit out there, but plausible based on what we've heard.
All right, let's get creative. Connect the strategy to a potential market view.
The idea. Given management's very strong commitment to hitting that 290% CRE concentration target by year-end 2027, maybe even sooner with loan sales, and given they expect growth to reaccelerate to mid-single digits once that's done, you could think about a long-term, maybe out-of-the-money call option on INDB stock, perhaps something expiring in late 2027.
Okay, so a long-term bet. What's the rationale? Why is that plausible, even if maybe outrageous?
Well, the outrageous is the time horizon and banking on a significant stock re-rating. But the plausible comes straight from their own playbook.
Right.
You're betting on successful execution, realizing the enterprise synergies, getting the efficiency gains from the new core system, actively managing down the problem CRE, and achieving that premium valuation they keep talking about.
So it's really a bet on the transformation itself, less about hitting next quarter's numbers, more about the bank fundamentally changing its risk profile and unlocking value over several years.
Exactly. Strategic execution play.
Yeah.
So let's wrap this up. INDB delivered a pretty solid Q2, good NIM, decent CNI growth, strong deposits, plus progress on the acquisition and managing problem loans.
Yep. But the road ahead is clear. Keep grinding down that CRE exposure, push the CNI strategy, integrate enterprise smoothly, navigate the credit environment carefully, and pull off those big system conversions.
So the big question for you is, how will this very deliberate shift away from transactional CRE, this focus on specific CNI segments, reshape INDB's position in the regional banking world? Will this strategic clarity truly lead back to that premium valuation they're aiming for over the next few years?
Lots to watch there as they execute.
Definitely. And as always, remember, this deep dive, it's purely for informational purposes. It is absolutely not financial advice. Please do your own research and consider your own situation before making any investment decisions.